Shankar Sharma joins us now. Shankar, what can I say? I'm sure you're not surprised because you saw this one was coming.
Well, I mean, it doesn't give you any pleasure to see a day like this, because ultimately I'm a very patriotic Indian, and markets can go up and down, but when a day like this happens, it makes you feel quite apprehensive about the situation in the country. Otherwise, a routine bear market is all okay. It really doesn't matter much. But this is something different.
What do you think is different about today's fall?
It's not about today's fall. The bear market started in 2008. We are now seeing the beginnings of it becoming a true bear market as opposed to being a stealth bear market. That is the big difference in today's fall versus whatever falls we might have seen after 2008. So till then, there was still hope that the bull market was alive, and people kept talking about that the mother of bull markets is ahead of us and all that. But the fact of the matter is that the bear market already started then. Today, it is becoming manifest. It's becoming stark. It's becoming apparent.
How ugly do you think it could get for us before we hit some kind of a trading bottom?
Why do you guys start talking bottom the first day the market falls? You don't start talking, when will the market top out each time the market rallies 2%. So when it falls 2%, why do you keep, start beating the drum of bottoms? Right now, capital preservation is the only goal. Forget about bottom fishing and hitting the bottom and buying on dips and all those kind of motherhood statements that people keep giving out with gay abandon on channels and in the media. This is not going to end very soon. And I've always said this, that this is a global bear market in emerging market countries. And India did not fall as much as the others did till a month and a half back. Now India is doing that while the others have kind of, been sideways the last couple of weeks. So, that's okay. That's the way markets are. Not everything falls at the same time. So India has fallen later, but it is also going to fall as much as the rest have.
You've not liked banks in the past. After the recent RBI action and given what has happened to rupee, has your bearish view on banks got cemented further?
See, I mean, those kind of trades come once in 5 years, 6 years. It was like the infra trade of 2007-8 when we turned bearish on infra. It was the telecom trade of 2007. These are secular compounding stories on the downside. So you can get a secular compounding story on the upside, like Infosys in the mid-90s, etc. But infra, telecoms, now banks are secular compounders on the downside. So from each level, you will think that they can't fall much, and they'll keep falling. And the central point in all these plays is that they all have leverage. And banks are the ultimate leveraged play because they have debt of 12 times, 15 times their equity. And leverage plays in bear markets are absolutely sitting ducks for big falls. So, our view, I mean, you know that, and I have said this openly on your channel from March, April onward, that banks were the prime area where maximum damage would occur in the markets. And so far, that's pretty much, what's been happening.
Shankar, the price to book or the P multiple, whichever way you look at it, for Indian private banks is still very expensive. It is still above the global average. So do you think the private end of the market has a long way down?
Absolutely. And I don't know whether you read my piece in Business Standard recently or not, which was that you're going to see even profits for the private sector banks slow down, as well as, in fact, I would think that they will be reversing. So you might see profit declines a few quarters down the road for all these banks, because they have been making inordinate amounts of money relative to the quality of businesses that they have. And those kind of aberrations don't last very long. It's lasted 7 years from 2003 onwards, 2004 onwards. But that story is also ending. So, if you put everything together, highly leveraged plays, because that's the essential nature of banking, an economic downturn, and plus the fact that they have been making money hand over fist in a commodity business. All those things are a pretty lethal cocktail.
Do you think IT stocks could make money on an absolute basis, not on a relative basis?
They might. Just looking at, obviously, the currency end of it. I don't think, like I said before on your show, that they're going to make you 50%, but they will definitely hold their head above water, which is more than what you can expect in most other sectors.
So one is better off buying into defensives, or one is better off even giving defensive stocks in your assessment, some kind of a skip?
Look, if you have a choice, you should skip. I don't think, obviously, the institutional investors have any choice at all. They have, because of the mandate, they have to remain invested, in which case they have to really change the way they have approached this whole business of investing. And I cannot be critical enough of the way the average fund manager has played the markets without any heed to really the big macros, the big long-term implications of being overweight on certain sectors. And like I said, they were overweight in infra, then in telecom, now in banks. Just riding a wing and a prayer, hoping that things will turn out. That's not the way investing works. First and foremost, the first duty is not to lose money. And look, in banks, you have lost 30-40%, and it doesn't look like it's stopping. So if you have a choice, stay away. But if you don't have a choice, then obviously you have to completely rework your strategy, which is not easy. Not easy for big funds to completely abandon a sector. But then obviously, they made money in the good times and they'll lose money in the bad times.
So you are not of the view that we are close to some kind of a trading bottom. In fact, you are of the view that this is certainly not the darkest dusk before the dawn.
Look, Nikunj, I mean, those kind of things, I've said this, that, a market like India or emerging markets don't typically hit bottoms that soon, because the macro situations in emerging markets is such that the central banks are always cautious. And when you have cautious central banks, then that is not a good situation for bull markets. When you have cowboys running central banks like it's there in the Eurozone, or in case of the US, who will say growth at any cost, debt be damned, debt to GDP be damned, forget about all those ratios, we need growth. When you have that mindset, then you will create bull markets. When you have mindsets of the kind that Indian central banks have, or for that matter, generally Asian central banks have, those mindsets are more risk averse. When you are risk averse, you don't create bull markets. It's as simple as that. So, and I don't blame, our central banks, because we have lived through very hard times. The US and Europe markets have not lived through the kind of times that emerging markets have lived through, be it Brazil or be it Russia, be it India, be it China. We've all seen huge yo-yos in our economic history, unlike the West. So they're not used to bad times. They're used to bad times, so we kind of hunker down. And that obviously then is not a good thing for bull markets to occur.
Okay, the Bank Nifty is down 5% now, 5% for the financial index to take a hit. That is sizable and that is huge. Shankar, do you have a ultimate number for the Bank Nifty? Or it's open trade right now?
Look, banks are typically valued on a price to book basis. I mean, that's a general conventional method by which you look at banks. The problem with that method is that the book value itself is not secure because of the huge leverage that is piled on that book value. So when you even have modest cuts on your asset value, even a cut of 2, 3, 4%, that's enough to wipe out your equity, or at least half of the equity in case of Indian banks. So the book value itself is, it's almost like a chimera. It's not real. It is only there when things are good. When things are bad, book values can evaporate like, a drop of gasoline on a hot day. And that's what is going to happen, that you will see big cuts on book value. So why value banks on the basis of book value? And the book value itself will be declining over the next, year, 2 years, maybe longer.
Shankar, stocks like JP Associates, GMR, GVK, Suzlon, they've fallen hard. Some of these stocks have lost even 95% of their, values from the all-time high. Can they fall more?
They can go to zero theoretically, in the sense that if you have a lot of debt on your balance sheet, which cannot be obviously replaced with equity in markets like these, then the interest costs of that debt completely erodes your book value. Stocks keep falling, they keep going into a free fall. So again, leveraged companies in a bad economic situation, really have no bottom, in a manner of speaking. They might have an equity value, like Kingfisher Airlines, I think it's 3 rupees or something. You might say it is 3 rupees, but then that 3 rupees is meaningless compared to the amount of debt it is supporting on those 3 rupees. So the same is true for the infrastructure end of the market. They have huge amounts of debt with no chance of being able to refinance the debt through equity. So in that case, the equity price becomes completely meaningless. They will not, when I say zero, it's not like really zero, but I'm just saying that a 10 rupee stock price or 5 rupee stock price, 8 rupee stock price is as good as zero. And that's where they'll remain unless they can find a way to finish the debt off by selling assets and all that, which remains to be seen.
Shankar, you've only told me the bad news. What is the good news? For every buyer there is a seller, every seller has a buyer, every story has two sides.
Does it?
Well, every opinion has two takes.
No, I mean, there is no silver lining in this. The only silver lining I can imagine is that, the government is forced to raise import duties of gold to 30, 40, 50%. They are just doing too little, 2% here and there. I mean, that is really not what is required. And I've said this, a good 6 months back, that we need to hike import duties to 30, 40, 50%, even if it leads to some degree of smuggling, which I don't think you can smuggle in 900 tons of gold into India. And of course, the RBI, which I've said, has messed up on every single major policy measure that it has done in the last 2.5 years. Hopefully, the government at least can plug the current account deficit by raising import duties to a substantially deterrent kind of level instead of this from 6% to 8 and then 8 to 10. And the other thing is the export sector will definitely benefit from this. So in a manner of speaking, the silver lining is that India's exports could be, doing better than what we have anticipated.
Shankar, how should one now approach exporters? So you've told me that IT could be a relative better trade. Is it now time to buy into other exporters also, which will benefit because of rupee, let's say pharma, some manufacturing names, textiles?
So the textile the market in India is not very well represented, and the companies are really not of great quality. So I don't think that's the place where you want to be seen. Obviously, IT and pharma are relatively good sectors, with reasonable exposure to the foreign markets. At least IT is almost completely exposed to the foreign markets, while pharma is to the extent of 45-50%. So those two are good hiding places, and obviously, I can empathize with average institutional money managers' plight that they can't put 100% of their assets into two sectors. So, they will hurt. I mean, that's the unfortunate reality, because they are not hedge funds. And the hedge funds who deal in India are really not hedge funds. They are really long-only players who have masqueraded as hedge funds. They have no skills to do shorting because they were always long-only players. And shorting is a very rare art and a very difficult one, at that. So even they will hurt. So I don't see who will escape unscathed in this whole fall, except a guy who chose to sit out the move.
But you've mastered that art of short selling, Shankar. I know that. So what is a good short trade?
There's no mastery of anything in this market. You try and do a little bit better than what the rest can do. And, of course, I'm skeptical by nature. And I do believe that bull markets are ultimately a product of macroeconomic fraud. So I never believe bull markets as much as I believe bear markets. I mean, that's just the way my mind works. So, I'm always a scared bull, but I'm really not that scared as a bear.
Shankar, if I look at India's exposure in all long-only funds, India is right at the top. Indian economy is not doing well. Growth expectations have got reset. We've got a weak currency. Up until now, we've got inflows. We've not got outflows. Do you think somewhere the biggest risk now could be outflows, and when foreigners, they start selling Indian stocks out?
They will obviously attempt. I'm sure they're attempting even now, even as we speak. The trouble with India is that, it's a shallow market because of the fact that the Indian policymakers abolished Badla, which was a huge benefit to the markets for even institutional sellers. So in our wisdom, we abolished Badla. We brought in FNO, which is a completely separate track than the cash market. FIIs are exposed on the cash market side, and they cannot sell enough in the cash market. So what happens in a situation like that is that markets then fall simply without selling. It can fall in a vacuum without volume. And that is what I fear, that you can see a 5% additional cut on a day without anything having been actually transacted.
So we are at 5576, approximately 5600 on the Nifty. Do you think Nifty could go below 5000, or that would be a bit stretch, or never say never in this kind of a market?
No, it's not at all a stretch. You're ending the bull market that started in 2003-04. And let's accept that, because if we don't accept it, then again we'll go back and try and do risky trades. So the bull market is ending. In that context, no level is really sacrosanct.
Sensex in 8,000 had gone to 8,500 and Nifty had cracked below 3,000. Do you think we can go there?
There's no point, thinking that far out. We have to think, every incremental 200, 400 points on the Nifty and 1,000 points on the Sensex. And I think, we are definitely headed to levels of around 5,000, if not lower, in the near term.
But Shankar, the bottom line here is that India is still growing. It could be 5, it could be 4, it could be 3.5. We can play with these numbers, but we are still growing in a nominal term and on an inflation-adjusted basis. And earnings are not degrowing unlike other countries. We are still growing on a absolute aggregate basis for the Sensex and the Nifty.
Well, we are growing so far. The trouble is, if you remember, back in February or March, the expectations for current year, 13-14, was that we would do 6.5 to 6.7% GDP. And I think every broker, worth his NSE card had an estimate of 6.5 to 6.7% out there. Look how quickly those numbers have been now reduced within the space of 3 months to 5%. And there's no telling whether 5% itself is sacrosanct. And markets don't value absolute growth as much as the delta in the growth. So if you were growing 20% and suddenly you start to grow 15% as a company, the stocks will fall 30-40%. Because you were being priced for 30% growth and suddenly you're growing half that. You can't argue that, look, I'm still growing 15%. That's not the way markets look at growth. The markets look at growth only in terms of relative changes of the growth number itself.